Good afternoon, everyone. Today is the 19th of June, Saturday, 2021. And today we will begin with a new session where we'll be discussing extensively on IFRS 15, with border on revenue from contracts with customers. And today we'll be discussing extensively on the requirement of the standard. And we also try to discuss from the perspective which we're coming from, where there's a change in the paradigm from the requirements of IAS 18 on revenue and IFRS 11, IAS 11 from construction contracts to the requirements of IFRS 15, with border revenue from contracts with customers. And today we'll start with various discussions regarding the project that gave birth to this standard. And we'll also try to look at the objective from the perspective of the standard. Okay, but before we proceed on this discussion, we'll try to appreciate the expectations of one or two or more of the participants. And the floor is now open for you guys to make your contribution so that I can be able to align my line of thought and presentation to the manner to which I will engage you as a whole. Over to you guys.
Yeah, thank you very much. Thank you everybody for this opportunity. I'm really very interested in this, in today's topic, because it's very relevant to what I do and what I will continue to do. And I really want I want to learn how revenue is applied, especially for service industry, like, you know, as you mentioned earlier today, telecommunication industry, and also maybe all these power generating or power transmitting organization. But more so for new organizations, new business models, like organizations that are adopting circular economy business model, or organizations that are into services, like maybe using artificial intelligence to, you know, to help their clients. So how will this standard be applied in this organization? For instance, I work for an organization that is into using artificial intelligence to assist dependent individuals. And this devices are always put in the homes of these dependent individuals. How will they recognize their revenue in order for it to be complete? So this is the aspect I want to look at it from. I want to look at it from the aspect of organizations like Uber, like BlaBlaCar, co-sharing of asset, and different aspects like that. So this is the area that I would like us to consider in this program today.
Okay, thank you very much.
Yeah.
Any other person?
Yes, sir. I would like you to shed more light about recognizing revenue for companies that are into promotions, like loyalty of customers, awarding and giving them incentives, you know, how we account for it, like the first video that we listened to. The man spoke about variables, like discounts, kind of a thing. You know, how do we book the loyalty from the point of the points at which the customer shows interest before you pay. You know, if some can be on credit, you know, things like that. How we account for their income and the variables associated with the sale. Thank you.
Okay, any other person? Okay. Let's start our discussion in this manner. The whole of our discussion will be in this order. Okay, we are going to look at the new standard the way it is, and we try to identify the objective of the standard and how we can meet this objective. And from there, we'll pick up the requirement of the standard bit by bit, following the 5-step model in addressing the issue. And by the end of the session, be it part 1 and part 2, as the case may be, we should be able to have better appreciation and understanding of all of our discussions regarding revenue from contracts with customers. Now, the first thing we need to identify here is the objective of the standard. Now, IFRS 15 was a project that was jointly undertaken by the ISB and the FASB. The ISB being the International Accounting Standard Board, and the FASB being the United States Financial Accounting Standard Board, jointly engaged in a project of revenue recognition standard. And eventually the standard was issued in May 2014 after a long ordeal. From the point of initial discussion papers, commentaries, exposure drafts, and etc., the journey towards the implementation and the use of standard spanned close to a decade. And this standard was fully thought through, even though in order to reach a compromise, the standard is a mix of principle, much more, and rules, slightly. And probably as we move on, we might see areas where such may be applied. Okay, and we understand the differences between principles-based system and the rules-based system in terms of one gives more latitude with respect to judgment, and one is much more of standard rules that have to be followed without necessarily taking into cognizance unique circumstances that might have affected the nature of such transaction. Okay, the core principle of this joint project towards issuing this standard was that revenue is recognized in a manner to depict the transfer of promised goods or services to a customer in an amount that should or would have reflected the consideration to which the entity expects to be entitled to with respect to exchange of those goods and services. Peradventure, this new standard, which is IFRS 5, emphasizes much more on transfer of control as evidence of transfer of promised goods and services to customers, which means the condition to be assessed in order to ensure that the promised goods and services have been transferred or delivered to customers will be born out of our assessment of if the customer now have control of such goods or has enjoyed the benefits of such services. And those are the things that are unique with respect to the standard. Even though in respect or in all respects, this is in tandem with what was obtainable under IAS 18 before the introduction of this standard. Furthermore, in order to identify the critical objective of this standard, we need to understand that this particular standard replaces 2 standards and 4 interpretations. The 2 standards which were replaced by these new standards are IAS 18, which talks about revenue relating to sale of goods, rendering of services, and assets yielding dividend, royalties, and interest as a form of return. Second standard replaced was IAS 11 that borders on construction contracts. Furthermore, various interpretations as those that deal with customers' loyalty, which is under IFRS 13, were somewhat retained as a component part of IFRS 15. And that speaks to the aspect where certain considerations were given with respect to variable consideration of variable payments. It further replaces IFRS 15 that deals with agreement for the construction of real estate. And also it was extended to replacing or to have replaced, since it has become effective, IFRS 18 that deals with situations where transfers of assets were made from customers to the entity. And finally, it replaced 6 that borders on revenue recognized or to be recognized as a result of barter transaction, especially as those that involves advertising services. Okay, these are considerations that we need to take note of with respect to the objective of the standard. Okay, now let's move further to discuss on certain critical things regarding the objective and how do we meet those objectives. Now, in practical sense, the objective of the standard is more tailored towards establishing the set of principles that an entity should apply in order to report its financial information that will be relevant and useful for the users of financial report or statements with respect to the nature of such contracts that could give rise to revenue recognition, the amount or pricing of such contracts, the timing with respect to recognition of such contracts, vis-a-vis uncertainties that surrounds revenue and its collections. All of this are critical considerations that we need to take into perspective in order to recognize revenue. Okay. Furthermore, to meeting this objective, certain things have to be taken into consideration. And what are those things? I want somebody to read out some of those things that are germane to meeting this objective. Over to you.
Okay, meeting the objective. To meet the objective in paragraph 1, the core principle of this standard is that an entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. An entity should consider the terms of the contract and all relevant facts and circumstances when applying this standard. An entity shall apply this standard, including the use of any practical expedients consistently to contracts with similar characteristics and in similar circumstances. This standard specifies the accounting for an individual contract with a customer. However, as a practical expedient, an entity may apply this standard to a portfolio of contracts or performance obligations with similar characteristics if the entity reasonably expects that the effects on the financial statements of applying this standard to the portfolio will not differ materially from applying this standard to the individual contracts or performance obligations within the portfolio. When accounting for a portfolio, an entity shall use estimates and assumptions that reflect the size and composition of the portfolio.
Okay, thank you very much. Now, this particular standard follows a 5-step model. And in our discussion, we're going to look at this 5-step model. And I'll put it to anyone here who has come across the model before. And what is your perspective of the model, or what is your understanding or your appreciation of the model before we proceed? Over to you guys.
Please, can you repeat the question? I didn't get it.
I said, whoever have come across the model before, what can you say about the model? What is your view?
The revenue recognition model?
Yes, under IFRS 15.
No.
Who has come across the model before? Okay, if you have not crossed across the model before, okay, I'll display the model to you now. Can somebody take us through this model before we continue from where we stop?
Okay. Revenue from contracts with customers is recognized based on application of a principle-based 5-step model. Step 1, identifying the contracts. Step 2, identifying performance obligations. Step 3, determine the transaction price. Step 4, allocating the transaction price to performance obligation. And step 5, recognize revenue when each performance obligation is satisfied.
Okay. Can you explain those steps to us?
Okay, based on my little understanding, step 1 has to do with identifying the contract. What step 1 is trying to say is that we need to establish if peradventure there is existence of contracts in the first place. That is, there is a legal obligation or legal or constructive agreement between the buyer or seller, or between the lessor or lessee, or between the landlord and tenant, as the case may be. That is the first stage. When it has been clearly identified that there is existence of contracts between the two parties, having identified that there is a particular instrument that is the substance of the contract, then we can say step 1 has been identified, meaning that the contract has been identified. Okay, for step 2, we try to identify the performance obligations. That is, having established that there is contracts between the two parties, okay, we need to know what obligations that each party is expected to fulfill. Is it in terms of, for example, if the contract is maybe lease contracts, okay? Now, under lease contracts, we have under lease contracts, there should be existence of I forget the real terms. Okay.
Can I continue on others?
Okay, what I'm trying to say is that for each of the for the particular subject matter in place, each party must know what is responsibilities to deliver in the contracts. Having established the responsibilities of each parties and the contracts, that is what we term as the performance obligations that each party is expected to fulfill in the contracts. That is what I understand by identifying the performance obligations. In the real estate where I work, for example, if a tenant wants to have interest in leasing a particular property like shop. Okay, the performance obligation for the landlord, who is the owner of the property, is to put the property in a condition that is tenantable, for the tenants to move in conveniently and operate successfully. And the obligations of the tenants is to satisfy all the conditions laid by the landlord, who is the lessor, before moving into the property. It could be in terms of consideration. It could be in terms of other conditions. Okay, that is the performance obligations in this regard. Then step 3, we determine the transaction price. Okay, having identified that there is existence of contracts, having identified the performance obligations, we have to determine the consideration to that particular subject matter. It is something that we can attach monetary value to. It is something that it will go with consideration. That is, and that consideration can be measured reliably. That is what I understand by determination of the transaction prices. Okay. Step 4, we allocate the transaction price to performance obligations. Okay, my understanding about this is if it is possible that the transactions or the subject matter can be divided into stages, maybe stage 1 to like stage 4. Having completed a particular each stage, we are going to have a price allocated to each stage. That is very common in contracts, in construction contracts, that when they certify a particular project to a certain extent, we are going to pay a certain portion of consideration. Then that is based on job completion. Okay, that is allocating the transaction price to performance obligations. Then recognize revenue when each performance obligation is satisfied. Then that is when, having satisfied all the aforementioned 4 steps, that is when revenue can actually be recognized in our book. Thank you very much.
Okay, thank you very much. Thank you. There are some salient things that I'll point you to, and that will correct some of the misconceptions or mix-up that might have been considered in the what's it called, proposition made by some of the participants now. Okay, let's first of all look at where the misconception comes from. One of the emphasis made by Nuruddin border on using example like recognizing revenue from lease transactions. Now, that will lead us to understanding that we need to know what is the scope of these standards. No standard is technically exhaustive. Rather, standard has its own limitation with respect to what areas is it expected to cover. When we look at this discussion here, the standard is limited to recognizing only revenue relating to contract with customers. That's number 1. Number 2 is that not necessarily all revenue attributable to contract to customer falls under this standard. Why is that so? It's because there are some special contract to customer that do give rise to revenue, of which, because of their peculiarities, a separate standard has been designated or dedicated for their own revenue recognition. In that light, such contracts will be scoped out of IFRS 15, which means all what we are going to discuss with respect to IFRS 15 may not apply to such contracts. Let's start with those contracts. The first one is leases. And we have discussed leases of recent with respect to IFRS 16, if you remember, which replaces IAS 17. Okay, let's take note of that. Why? Because IFRS 16 has exposed us to how we recognize revenue with respect to lease transactions, except for some aspect which we have been referred to from that standard back to IFRS 15. And if you go back to the video or our learning note, you'll find out that when we discuss sales and leaseback, we emphasize on if actually the transfer of the asset constitutes a sales. And where it does constitute a sales, that is viewed from the perspective of if control of the asset has been transferred to the customer. And that time we make reference to IFRS 15. And in that manner, we'll account for it appropriately under IFRS 15. That is one of those things. Second one is insurance contracts. Insurance contract primarily falls under IFRS 4, which has now been fully covered by IFRS 17, which is taking effect from 2021 into 2022. Okay, and such contracts that constitute insurance contracts are equally not covered under the standard. Furthermore, financial instruments are equally not covered under this standard. Why? Because there's a separate standard for financial instruments. And this standard varies from IAS 32 to IFRS 9 up to various standards that deal with other investment or equity investments in other entities. Okay, and finally, non-monetary exchanges between entities in similar line of business to facilitate sales to customers or potential customers is equally scoped out of this. For example, this standard would not apply to contract between two oil companies that have agreed to exchange oil to fulfill demand from their customers in different specialized locations on a timely basis. What that simply means is that similar to what we discussed or what we know under IAS 18, when you carry out what we call product swap, which are more or less of similar characteristics or similar value, such will not have given rise to revenue recognition. Rather, such will be treated as an exchange of products. And in that light, such is not within the scope of IFRS 15, which means by implication, these four categories of transactions, even though they emanated from contracts with customers, will not be accounted for under IFRS 15. Rather, they will be accounted for under their various standards as earlier discussed. Now, furthermore, before I venture into other discussions, okay, I will more or less want us to look at some other considerations. Now, let's look at other considerations. Thereafter, we'll come back to discuss some key definition terms that we are going to be making use of as we move on. Now, within the scope Every other contract with customers, other than those 4 that are scoped out, will be appropriately accounted for under IFRS 15. But we are also aware that there are some transactions that may give rise to revenue as a result of contracts, but not with customers. Such will be accounted for under relevant standards. I want somebody to take us through this journey.
Okay. An entity shall apply the standard to a contract other than a contract listed in paragraph 5, only if the counterparty to the contract is a customer.
Okay, can we stop there? Can we stop there? Now, the first thing you need to know, it said other than those listed there. Those listed in paragraph 5 of the standard are the 4 contracts I've identified. 1, lease contracts. 2, insurance contract. 3, financial instruments contract. And 4, contract that give rise to non-monetary exchange of goods. Secondly, even if there's a contract than those 4 I've mentioned, but they must be with what? A contract engaged with a customer. The question then is, who is a customer? We'll come to answer that question. Which means even if it is not any of those 4 I mentioned, but it's a contract that could give us revenue, but not with a customer, therefore such may not fall under this requirement of the standard. Can you move on?
A customer is a customer. A customer is a party that has contracted with an entity to obtain goods and services that are an output of the entity's ordinary activities in exchange for consideration. A counterparty to the contract will not be a customer if, for example, the counterparty has contracted with the entity to participate in an activity or process in which the parties to the contract share in the risks and benefits that result from the activity or process, such as developing an asset in a collaboration arrangement, rather than to obtain the output of the entity's ordinary activities.
Now, what we are saying here is this. Somebody might contract you to buy goods from you, but that person is not really a customer with you, but rather that person is more or less like a strategic partner with you in order to fulfill that contract with a customer. Example is if you approach a manufacturer to say, okay, manufacturer, I have this contract I've won with an organization or I've won with government. And the contract is such that I want us to partner where you would develop the product to the specification such that at the end of the day, since I have access to the contract and you have access to the product development, we can partner our resources and put up this product in order to fulfill the demand of a particular organization, which is a customer. And we will share returns or revenue or income in a proportion that has been agreed by both parties. Such transaction between the entity that brought such a contract with you will not constitute revenue. Rather, what will constitute revenue is with the final customer, which is the organization that is expected to have control over the goods. That's an example. Another example may be where the person or the entity that approaches you will invariably be considered as an agent of you or the other in order for you to fulfill that contract with another person. Which means in such an instance, you're dealing with such an agent, whether for commission purposes or profit sharing purposes, would not be tantamount to be recognized as a contract with customer because that is not a customer. Why? Because we have gone ahead to define a customer as a party that has contracted with an entity to obtain the goods or services majorly in its own individual capacity, and that an output of such an entity is within the ordinary activities that constitute how exchanges take place for consideration. Okay, those are practical examples where you dealing with a party in a contract may not give rise to you dealing with a customer, but rather you dealing with an intermediary, which is like a means to a end. And therefore the end is the actual customer who is expected to obtain the promised goods or the promised services. Second consideration, what if a contract in its whole essence may not have qualified as contract with customer, but a part of it do qualify? What do you do in that instance? Over to you.
A contract with a customer may be partially within the scope of this standard and partially within the scope of other standards listed in paragraph 5. A, if the other standards specify how to separate and or initially measure one or more parts of the contract, then an entity shall first apply the separation and or measurement requirements in those standards. An entity shall exclude from the transaction price the amount of the parts or parts of the contract that are initially measured in accordance with other standards, and shall apply paragraph 73 to 86 to allocate the amount of the transaction price that remains, if any, to each performance obligation within the scope of this standard, and to any other parts of the contract identified by paragraph 7b. B, if the other standards do not specify how to separate and or initially measure one or more parts of the contract, then the entity shall apply this standard separate and or initially measure the parts or parts of the contract. This standard, okay.
Okay, what we are saying is this. When you have a host contract that we might call a hybrid contract, of which a part of it qualifies as revenue from contract with customer under IFRS 15, and another part qualifies as other transaction that meet the requirement of another standard. What you have to do is to more or less first try to apply the modus operandi of separation based on those standards. For example, let us say a part of the contract deals with financial instruments. How does financial instrument recognize that part of that contract for that purposes? That will form a basis to say the residual will now form the transaction price allocated to this revenue contract. Otherwise, if other standards do not necessarily specify how such will have been allocated or separated, therefore, you will more or less rely on the provision as we move on this standard on how we are going to more or less separate. And as we go on in this standard, you find out that the default basis of separation under this standard is to use standalone prices. But again, there are other three methodologies that can be used if such standalone prices may not have been in existence as at that point in time. We are going to meet up with that once we get to the analysis of step 3. Okay, that is that. Now let's move further to the last one.
This standard specifies the accounting for the incremental cost of obtaining a contract with a customer and for costs incurred to fulfill a contract with a customer if those costs are not within the scope of another standard. See paragraph 91 to 104. An entity shall apply those paragraphs only to the cost incurred that relate to a contract with a customer or part of the contract that is within the scope of the standard.
Now let's look at what they are trying to say here. You might still come across it as we move on, and in case we are unable to or we skipped it unknown to us, let me quickly discuss it. Cost of a contract. Now, what it means is that there are incidental costs or incremental costs in obtaining a contract. And we have to separate the cost into cost of obtaining a contract and separate it from cost of fulfilling a contract. Now, why are we doing this? The essence is that cost of obtaining a contract is expensed to profit or loss as incurred. Rather, cost of fulfilling a contract is considered as an asset that is capitalized and amortized accordingly. Accordingly means amortized to reflect the economic benefits associated with the cost. Now, what it simply means is this. If you incur a cost to win a contract, that cost is practically a cost that is incurred in a manner that whether you complete that contract or execute that contract or not, that cost is deemed to have been incurred, and such cost cannot be recovered. Such cost will be considered to be a cost to obtain a contract, and it is expense because that contract has been obtained. Whether you now do it or not is your own what? Business. An example of such costs. Example is commission. When you receive commission, you pay commission for winning a contract, for getting a customer. Such commission are expense because they are costs incurred in obtaining that contract. Okay? And there are also other costs, which the standard describes much more as incremental costs. Such costs are those that you incur it incidental to fulfilling the contract, incidental to more or less delivering on the promise, goods or services. These are costs that are associated with the progress you make in ensuring that your performance obligation with respect to that contract is fulfilled. Such costs are going to be capitalized, okay, and amortized over in a systematic way that reflects your revenue recognition. Okay, but there's this keyword that will assist us in identifying or separating this. Sometimes there's a thin line between identifying those costs to be expensed by way of obtaining the contracts and those that will be capitalized as a result of incremental costs associated with fulfilling the contract. And what we are going to look at as a basis is the success factor. If the cost is deemed to be incurred as we progress towards successfully completing the contract, that is, delivery on the performance obligations, thereby transferring the promised goods and services, such costs will be deemed to be cost of fulfilling the contract. Otherwise, such costs will be deemed to be expensed just in order to obtain the contract. Does that make sense to us, please?
Yes, sir.
Any question there?
I have some questions, but I don't know if this is the right time to ask them.
Okay, okay. Does the question relate to what we have discussed so far?
Somehow it relates to whether the standard applies or not.
Okay, okay, when we get to, okay, ask the question since we've discussed the scope. Go ahead.
Okay, number one is that, there is this business model around here that you can get a jacket or sneakers and use them for, let me say, 1 or 2 months and then return to the seller. You just have to pay a stipend, and then some other customers will come after you, hire the same sneakers or jackets and still continue to use, until the value is completely extinguished. So that means that there are a series of customers that are using the same product over an extended period of time. And looking at the value of these assets, they are low value, they are not capital asset. So will this still fall under IFRS 15 or IFRS 16? Which one? That is number one. Secondly, when you use these products, there are some products that you buy upfront, let me say from IKEA. Maybe you are buying, let's say, mattress, or maybe not really from IKEA, maybe from, maybe you're buying the sneakers and you return it to get a new one. Maybe you have to pay a little stipend, you have to add something to it. So how do we still treat this transaction under IFRS 15?
Okay, thank you. Now, the first one borders on, when you look at the nature of what is involved, this will not have qualified as a lease, which was the first situation of buying sneakers, wait for some time, return it, and that person comes for that same sneakers, wait for some time until the final person wait until it's worn out. Is that not?
Yes.
That will never have qualified as a lease in all respects when you look at the substance of it. And coupled with the fact that you also have identified it as something of a low value. Okay, it's not like vehicle. If it's like motor vehicle by nature, we'll further ask 1 or 2 questions to look at the whole substance. But in this case, with what you have provided, it will still fall as what qualify under revenue from contract with customers. Okay, and when we get to issue of revenue recognition, and some other things I think we'll discuss on the implication of how such will have been recognized in the books of the entity. Okay, the second question, I think borders on trading. Okay, when you buy an item, like let me say, for example, what is common in the US, which I don't think is common in France where you are, is that you buy a car and 2 years into the car life, there's another model, you're trading the old model, you put some differential value and you take the new model. Okay, that transaction also still falls under revenue from contracts with customers in all respects. Okay, I think that is the answer to the question now. Probably as we move on, when we get towards demystifying the requirement of each stage of the 5 steps in the revenue recognition model, we'll be able to provide further discussion about how you measure the transaction and how you account for it as deemed fit. Okay, that is that. Any other question? Now, in the absence of no question, let's look at 8 key terms that I've put together that we need to have better appreciation of in order to understand better all what we need to know and practice with respect to revenue recognition. Now, the following are the key terms that we need to keep abreast of. The first is, what is a contract? Second is, what do we understand by contract liability? Vis-a-vis contract assets. Okay, I think I skipped that. Contract liability. Contract assets. Who is a customer? What do we consider as income? How does income differ from revenue? And what is a performance obligation? When we emphasize standalone price, as I've mentioned it earlier, what does that mean? And again, what is transaction price? Now let's take a few minutes to discuss this. Now, a contract must be established by law. This is the second aspect we'll be looking at, if not the third, from all discussions we've had on various transactions within financial reporting. Under lease, we discussed it or we emphasized it. Under financial instrument, I think we emphasized it. Now, for the third time, we're also emphasizing it here, where the legal form seems to have more weight than the economic substance or financial relations of a transaction. And what it with respect to? With respect to, if there's no underlying contract that is not legally admissible, in which it can give protection towards ensuring recovery of value, therefore, you shouldn't talk about revenue. That means revenue is nothing when there's no underlying contract, because revenue, as we move on, must be something that can be converted into economic value by way of collection. And one of those things that we know is that anything that is admissible in law or in court will give you more assurance of recovering your value or harnessing your value. But once it's not legally binding and you believe on trust, therefore revenue will not be recognized based on trust, but rather it will be recognized based on legal backing of ensuring collection of your revenue in cash or equivalent of cash. And that is that. Therefore, contract then is defined as an agreement, usually in writing, though may be implied. But it's an agreement between two or more parties that creates obligation to a party, which is the customer in this case, or to both parties, and create enforceable rights. Now, it is key word by the choice of enforceable rights. Enforceable right is the legal backing that your contracting has. Where there's no underlying contract, on no occasion can you even talk about recognizing revenue. That's what you need to take note. Okay. Second one is contract assets. What is a contract asset? And how does contract asset differ from receivable, or what you know as trade receivable? Trade receivable does not have, what would I call it? Does not have any condition attached for its collection other than passage of time, which means it is unconditioned or unconditional with respect to receiving cash or its equivalent from your customer other than passage of what? Of time. But there are other collections, or I'll call it collectibles, that are still conditioned upon you as an entity fulfilling a particular consideration or performance obligation before it can be paid. Such collectibles or assets will be considered contract assets and not receivable. The standard defines it as an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is conditioned on something other than the passage of time, which means you still have one or two things to do in order to fulfill the condition that will not make you entitled to collection of those cash. In that regard, that will be considered a contract asset. Okay. Any other question? Furthermore, a contract liability. Now, a contract liability evolves when an entity has an obligation to transfer goods or services to a customer for which the entity may have received consideration from that customer. A practical example of it is when customers deposit ahead of you delivering products, which means if your line of business is like cement business, where it is cash-based majorly. Today, if you want to buy cement, probably you'll have deposited 1 week, 2 weeks, 3 weeks ahead of time. Therefore, if I'm the entity in which you have deposited into, such amount you deposited is what we consider as contract liabilities, which you can equally describe as amount due to customers or deferred revenue. It is deferred revenue because you have not yet delivered on the promised goods, neither have you rendered the promised services. Now, who is a customer once again? For the hunting time, a customer, from our perspective, will be considered a party that has a contract that has been contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for a consideration. Now let's look at other 5 key definitions. Income. Our definition of income, if you go back to the video, as at the time we started this program, the video on conceptual framework for financial reporting, we extensively discussed what an income is. And borrowing a leaf from that, we concluded that an income is an increase in an economic benefit arising from inflows or enhancements or increase in an asset or decrease in a liability that would have resulted in an increase in equity other than those that can be attributed to contributions that are made by equity participants, or rather made by owners of equity, which means income is a gross inflow that may have been associated with use of an asset, thereby making an asset to increase in value, or management of liabilities such that it brings about reduction in liabilities not attributed to contribution by equity participants nor repayment or payment to liability holders. But how does income differ from revenue? From the conceptual framework, we group income into two parts. That is, income is made up of two parts. But the larger part of many income, except in unusual situations, are revenues. And revenues are the income part of income that are attributable to the normal course of business, or what you call ordinary course of business, in which an entity engages in its daily activities, which means revenue is a subset of an income. And it is an income solely attributable to the ordinary course of business by an entity. And the other component of income other than revenue is what we term as other gains, or which I prefer to call other income, which are any income other than what will have been categorized and recognized as revenue. Okay. Furthermore, we discuss on performance obligation. Performance obligation is key and instrumental to revenue recognition. And performance consideration entails the embodiment of promise or promises that has been made as a result of a contract by the entity with its customers, in which it is required to transfer a promised good or a promised service, either as a single identified good or service, or as a bunch or bundle of goods or services. But what is unique about it is that this promise must be distinct in nature. And later on, we are going to describe what distinct means because of issues that may border on separate or different performance obligations that have to be fulfilled at varying times. Furthermore, we said it could also be a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to customers, which means in some cases, you can separate performance obligations, especially when such obligations have to be fulfilled at different times. And in other situations, you may be unable to separate because though they are distinct, but they share the same economic, and other attributes that may not require separation, as the case may be. Finally, we discuss on transaction price. What is a transaction price? Transaction price is all of the consideration that an entity expects from the customer as a result of the entity delivering on its promised goods or services, which means the consideration that has been agreed upon by the entity and the customer in fulfillment of the performance obligation by the entity. And that's what we call the transaction price. And as we move on, we are going to discuss all of this. For example, transaction price will be if you enter into a contract with customer to deliver 10 laptops and you've agreed the price of those laptops. The price as agreed for the supply of those laptops, 10 laptops, will be deemed to be the transaction price, which is the amount of the consideration expected to be received by you as an entity from the customer upon you delivering those 10 laptops. And that is what we call the transaction price. Any questions so far here? Any question? Any question? I want it to be participatory because we are yet to start the session. Any question? Now, let's take note of something. In actual sense, revenue does not include any of the following. Sales taxes, or what in Nigeria we call value added tax. You can say now. And it does not include service taxes or any levy refundable by customers. Especially as payable to a third party. Okay. For example, if as a result of you selling a good, the contract is such that 2% of the value of the goods will be paid in addition by the customer to an intermediary or agent or lawyer or whoever it may be as regards the contract being fulfilled by the entity. That 2% is payable to a third party through probably the entity. That still does not constitute revenue to the entity. Likewise, sales tax or value added tax or GST You are just an unpaid agent of the government in order to collect such taxes and remit to government, which means in that regard, you do not recognize such an amount as revenue. Rather, upon receipt of such amount, you more or less take it as payable immediately to that third party. Okay, now let's look further. Revenue recognition. Generally, revenue is recognized when the entity has transferred the promised goods and has transferred the promised services. To the customer. Now, there is this logical sequence or process that IFRS 15 has designed, which in the financial reporting space, we consider it as a 5-step model for revenue recognition. I'll say a general principle of revenue recognition. Remember, we've displayed the 5 principles earlier, which you didn't try to explain to us, even though we'll go granular level as we try to explain it to ourselves. Okay. Now, these 5 steps are iterative, which means they are steps you will repeat every time a contract is created between you as an entity and your customer that could give rise to revenue recognition. And there are 5 key criteria that must be met before revenue can be recognized. The first one being that there must be a contract distinct in nature that can be separately identified. That point to the fact that certain promises exist between the entity and the customer that will give rise to revenue recognition. And after that, that in the contract, it can be easily identified that there is a performance obligation, at least one, or there are performance obligations which created has been distinct from one another. And that this performance obligation is such that it is priced in the contract in an amount that is expected to be received as a consideration in fulfillment of that promise by the entity to the customer. And that there is a reasonable and systematic basis to which we can allocate the transaction price to various performance obligations, especially where there are more than one obligation to be fulfilled. And thereafter, We recognize revenue as performance obligation is satisfied, either at a point in time or over time. We'll come to those two later. Now, in the process of trying to explain these 5 steps to us, there's a misconception I noticed in what Nurudeen explained, where the explanation he gave for step 4 was explanation that actually explains step 5. And once we pick those steps one by one, we'll be able to understand what step 4 actually means. Because step 4 is a function of step 2 and step 3. Okay, and we'll get there. Which means we'll go back to what I've shared earlier on the slide, where we said revenue from contract with customer is recognized based on the application of a principle-based 5-step model. Step 1 being you identifying a contract which is legally enforceable. Thereafter, you identifying whether there is a performance obligation or they have performance obligations, distinct and separable. Step 3, this with determining the transaction price as a whole in that contract. And step 4, allocating the transaction price where you have more than one performance obligation. And step 5 is where you recognize revenue as the performance obligation individually is being performed or satisfied. Any other question? Any other question?
So I have a question in this identifying of performance obligation. So can the distinct performance obligation be separated by time? For instance, if you have a similar service that you must offer over a period of time. So can we say 1 month, I mean, each month within 12 months of a service can be identified as performance obligation?
No, sir. That's part of the misconception that was given in step 4, which Nudin tried to explain. A performance obligation, if we go back to our definition, is a promise in a contract with a customer to transfer to the customer a good or what? Services that is distinct, or series of distinct goods or services that are substantially the same and of which they are performed at the same time. Now, what your question is that if in a contract, let me give you an example of a contract like that I want to point out. Contract of construction. You have to build a road, 10 kilometers. And it will take you, let's say, 1 year. But that 1 year is split into 12 months. That is a single performance obligation. Do you get what I'm saying now? But the question is, how do you now satisfy that performance obligation? Is it the one you satisfy at a point in time or over time? For construction, in the manner I've explained it, it is more of overtime, which means if that overtime is 12 months, it means on a monthly basis, you recognize the portion of the revenue that has been fulfilled by way of performance obligation. We'll get there. But if it's production of goods, for example, cement, Dangote will recognize revenue at a point in time because he knows the number he has delivered to you. Therefore, that portion, whether you are paid in advance or you are paying in arrears, you will recognize that portion of goods transferred to you. And if he has not transferred all, but he has collected money from all, you can't recognize all as revenue. You only recognize what he has delivered, which means such item will be recognized at a point in time. But for those ones that are much more of service, continuous service, be it a professional service, be it construction contract, to some degree, not all construction contracts, and I'll give you an example when we get there. Those ones may be recognized over time, and we're going to see the conditions. Are you get what I'm saying now? So that you don't miss the issue of you still doing the work over some months as being different performance obligation. No, it's still one obligation. Because the obligation is that deliver 10-kilometer road, not to deliver 1 meter road per month, no. The contracts, the substance of the contract is you want a contract for 10-kilometer road, but it will take you some time. Dangote on is deliver certain metric tons of cement for construction of road. Have you delivered it or not? And that one is at a point in time. Does that make sense, sir?
Yes. Yes, sir.
Okay. Now let's look at the first one. Identifying the contracts. How do you identify a contract? And what are the attributes that the standards has given us towards identifying a contract? Now, to identify a contract, the following factors or criteria must be taken into consideration. Now, let me switch my board. There are about 5 or 6 criteria to be met to identify. There are 5 in nature, but the next one is based on the fact that from law that we all know, which is legal practice, and also from black, what do you call this law dictionary? Is it black? I can't remember. Is it black dictionary? We call it black law dictionary, or what do you call it? A contract is defined to either be in writing, oral, which is verbal, or implied. Okay, but what matters is that is a contract admissible in a law court? Okay, I mean Black Law Dictionary. That's what I was trying to explain there. But based on IFRS 15, these 5 criteria must be met, starting with the first criterion. The first criterion is that the parties must have approved, is a must, that they have approved that contract. And not only that, from their countenance, body language, action, inaction, they are committed to fulfilling the terms, all of the terms of the contract. Take note of this. And I'll tell you why. It is only when these have been met that you further evaluate to say, okay, what rights from that contract has been established for each party with respect to delivery on the promised goods and what? Services. Which means each party's right regarding goods and services to be transferred can be identified. I deliver 100 bags of cement. You will pay me so amount at so time. That means second criterion has been met. Okay, the third criterion is that clearly you have identified the payment terms. The payment terms is 1, the transaction price. 2, variable payments or consideration. That one is not mandatory, probably if any, if such exists. 3, timing of payment. And probably actions to remedy payments, etc., are clearly spelled out in the contract. Without such, you cannot claim that the third criterion has been met. What is now key, which has been introduced by IFRS 15, is that even when you met these 3, that contract must meet what ordinarily in the normal course of your business as a commercial substance, as an economic relations, makes sense commercially in the way and manner you carry out your ordinary what? Activities. Which means what we are saying is that revenue should not necessarily be recognized for artificial transactions. Which means artificial transactions should not necessarily give rise to revenue recognition because it's fictitious in nature. Which means commercial substance must be evidence in your contract. And finally, why I said note of this term is that even when all of these 4 criterion individually has been met, the 5th criterion, if it's not met, revenue cannot be recognized. And what is it? Not only that you have fulfilled all of this, but to a high degree, it is probable that you as an entity that has made that revenue has the ability. Equally, your customer has the capacity, which means the ability, the willingness, the effort, and every other thing to make payments so that the consideration as expected from your transaction price will flow to you as an entity based on your entitlement or rights. Which means that if revenue deemed to have been made may not be collectible in cash, whether in part or in full, such expectation will be factored in your revenue recognition, which means it is not necessarily that your transaction will be recognized in full as your revenue if part of it is not capable of being collected by way of consideration from your customer. And we're going to see situations where such may arise and how we treat such in the box. Any question about step one? Any question about step one? Any question about step one? Any question about that?
Okay, I just have one question regarding this collectibility of the consideration from the customer. Does this also factor in the risk that the customer might be unable to pay? Like all these things we learned in financial instruments, that is the default risk.
Okay. Now let's take notes. In determining the consideration, receivable at the point of revenue recognition, all facts and circumstances known to the entity may have been factored in recognizing that revenue, including element of credit risk that may be embedded in it. But subsequently, after the revenue has been recognized, effect of changes in credit risk will not affect revenue, but rather will be treated in line with the requirement of IFRS 9, where impairments assessment will be carried out with the aid of the expected credit loss model, as we have discussed under financial instruments. And again, I'll refer us back to part 1 to part 6 discussions we've had on financial instruments. You could go on YouTube and check those videos, apart from the one I've given to you on Zoom platform. Does that answer your question, sir?
It does.
Okay, let's look at situations where we have combined contracts as a single contract. What happens in that situation? Can you read this for us?
Combination of contracts. An entity shall combine two or more contracts entered into at or near the same time with the same customer or related parties of the contract, and account for the contract as a single contract if one or more of the following criteria are met. 1, the contracts are negotiated as a package with a single commercial objective. 2, the amount of consideration to be paid in one contract depends on the price or performance of the other contract. Or 3, the goods or services promised in the contract, or some goods or services promised in each of the contracts, are a single performance obligation in accordance with paragraph 22 to 30.
Okay. Thank you very much. Now, any questions so far on these are discussions? Any questions so far? Therefore, we've dealt with step 1. Now let's go back. Let's look at step 2. Okay, before we look at step 2, we'll still come back to contract modification, but let's look at what contract modification is all about. Contract modification is synonymous to what we experience under lease accounting, where we have lease modification. Now, the same way, contract of revenue with customers can equally be modified as you move into that contract. What does that mean? You have a contract for 10-kilometer road. Apparently 10-kilometer road is from Yaba to Maryland. And you've just gotten to, probably just gotten to Pangrove. And the government call on you to say, okay, we don't want you to get to Maryland again. Stop at Anthony. Why? Because we are putting up another town planning with respect to smart city that will change the landscape of between Anthony and Maryland up to Ikeja. Or they say, okay, don't stop at Maryland. You have to extend it to Ojota because we've tried to modify the town planning stuff to capture Ojota along with Maryland axis, which means modification might tend to extend or might tend to construct the contract. And modification of the contract might also come by way of giving you a distinct contract in addition to the existing contract, but as a combined contract. Therefore, regardless of what has happened, how do we treat a modification of a contract? I'll not go detail at this level. Probably when we get to part B, when we've had preliminary understanding of each of these steps, we'll now go into practical demonstration of contract modification under IFRS 15. But I want somebody to assist me with this. Contract modification. What is it? And it could come in 3 fashions. And what is the implication of each fashion? And how would that be treated in line with the requirement of IFRS 15?
Okay, contract modifications. Okay, Asama, please go ahead.
Okay, contract modifications. A change in enforceable rights and obligations, that is the scope or price, is only accounted for as a contract modification if it has been approved and creates new or changes existing enforceable rights and obligations. Contract modifications are accounted for as a separate contract if and only if 1, the contract scope changes due to addition of distinct goods or services, and the change in contract price reflects the stand-alone selling price of the distinct goods or services. Contract modifications that are not accounted for as a separate contract are accounted for as either 1, replacement of the original contract with a new contract, that is, if the remaining goods or services under the original contract are distinct from those already transferred to the customer, or 2, continuation of the original contract if the remaining goods or services under the original contract are distinct from those already transferred to the customer, and the performance obligation is partially satisfied at modification date. 3, mixture of point 1 and point 2, if elements of both exist.
Okay. Who can explain what we tend to achieve there? Who will explain that?
Okay, let me go then. So this statement is stating that contract modification can be accounted for as a separate contract if these two conditions are met. That is, there is a change in the previous performance obligation. That is, like the example you made, if maybe the contract is made bigger, the supply of goods and services is changed, maybe a reduction or an addition. In that condition, the contract modification can be accounted for as a separate contract. And the other part of it is if the standalone price of the addition or deletion, if it reflects the standalone price of the addition or deletion in the contract modification, then in that case, we can account for the contract as a separate contract. On the other hand, it also mentions that contract modification may not be accounted for separately if these two conditions or a mixture of these two conditions are met. One of the conditions is if there is a replacement of the original contract in the new contract, that is, maybe the goods or services that were previously agreed in the first contract were changed from, maybe a part of it had been supplied to the customers, or maybe there has been performance initially. In that case, the contract modification in this case may not be accounted for separately. I don't know if I covered the 2 points.
Okay. Yeah, you tried. Who else?
Okay. What we just want to establish here is to actually know that the modification that takes place actually affects this original scope of the initial contracts. If that is the case, it means the contract will be accounted for separately. And secondly, if the modifications brings about a standalone price different from already agreed price, this will also tantamount to recognition of the contract in as a separate contract. If these if the modification different these two conditions, it means all other conditions are not subject to a separate contract. It means apart from the two aforementioned conditions, all other conditions, such as replacement of original contracts, will not result into recognition, accounting for the contract as a separate contract. Thank you.
Okay. Now let's look up on something. Now, let me break it down. Naturally, when there's a contract modification, we need to identify if it is distinct. If it is distinct, which means distinct in the sense that this is a new contract that the performance of the former contract may have nothing to do with this new contract as a standalone. We say it is distinct. Secondly, it's not only when it is distinct, but we will see it as distinct if there's no attachment with respect to its pricing to the existing contract. Otherwise, if its pricing is negotiated in such a way that consideration was given effectively because of the one ongoing, therefore we can't say it's distinct in material fact. Therefore, in that case, we'll treat it as multi-contract as a whole, which means as a modification that is not distinct. But if he has passed the distinct test, vis-a-vis that the price reflects what a standalone price will have been, therefore, we have to take that part of the modification that is new as a separate contract. Which means the one we are doing before, we'll do it as if nothing has happened on the new contract. New contract, we also do it as if we don't know of anything going on before. This is a separate contract, and we're going to treat them independent of one another. That is it. Conversely, most modified contracts are somewhat not necessarily distinct, or where they are distinct, they are materially attached by way of consideration and other factors to the existing contract. And in that situation, we have to treat them as a single contract and make adjustments to the existing contract with respect to revenue recognition. And mostly, this comes into play when we have performance obligations that are expected to be performed over time. Barely do you have most of this modification on performance obligation that is performed at a point in time. Now, the standard went further to assist us to identify easily when we need not separate, but rather make that adjustment by way of measurement to revenue on the existing contract in order to bring it up to speed of what the value is today. And the two alternative conditions that may signify that we don't need to separate such contracts is that one, if the modification introduces a new contract that tends to replace the existing contract, where what was fulfilled under the old contract or existing contract is seen as a partial fulfillment of this revised or new contract. Therefore, we say that we don't need to separate. Or you find yourself in a situation where the new contract is seen, or the modified contract is seen as an extension of the existing contract running, which means it's just like you're extending the existing contract. It's still the same route, but you are just increasing it in meters of coverage. In that situation also, we are just going to consider it as part of existing contract that have to be remeasured in order to meet the current term of the modification. Remember, modification could be in scope, modification could be in pricing, and could be both. And the standard also went further that even though the two considerations I mentioned earlier, at least if one of them is present, such separation may not be required. But even if both are present, such separation may also not be required. And that is that from my perspective. Any other question before we move to step 2? Now let's look at step 2. Step 2, try to identify performance obligations. And step 2 makes us understand further that performance obligations are contractual promise by the entity to transfer to customer distinct goods or services, either individually, in bundle, or as series over time. Furthermore, it makes us understand that the activities of the entity that do not result in transfer of goods or services to customers, that by way of certain internal administrative setup activities, are not necessarily performance obligation to the contract with the customer and would not have given rise to revenue recognition, which means it is critical for us to know what performance obligation is and what distinct mean in all respects. But there are 2 criteria that must be met for us to treat transfer of goods or services or both as distinct. The first one is this. It is distinct if the customer can benefit from the good or service. And that can be seen from 2 perspectives. 1, benefit from the goods or services can be through either use, consumption, or sale, but does not qualify as scrap, or those aid in a way to generate economic benefits. 2, the customer can benefit from the goods or services if the benefit from the goods or services can either be on its own or together with other readily available resources. In this case, those which can be acquired by customers from the entity or any other party. That is the first criteria. The second criterion speaks to the promise to transfer a good or a service is separable from other promises in the contract. That means there are distinguishing factors that can make us separate the promised goods or service from others. And this can be done in these 2 ways. 1, the assessment requires some level of judgment from management of the entity and with respect to considerations of all relevant and material facts and circumstances that surrounds the contract. 2, a good or service may not be separable from other promised goods or services in the contracts if any of these arises. 1, there are significant integration services with other promised goods and services. For example, you deploy a system, a technology, and that technology cannot function except there's an integration that can only be carried out by that particular entity in order to allow it to function as a whole. Therefore, in such a situation, such promised goods or services may not be separable. Or a good or service may not be separable from other goods or services in the contract if it modifies or it customizes other promised goods or services, which means the introduction of such goods or services brings about modification to another separate good or services inherent or existing with the customer. Thirdly, a good or service may not be separable. Are we mute? Thirdly, as I said, a good or service may not be separable from other promised goods or services in the contract if it is highly dependent or interrelated with other promised goods or services. In this regard, such may not be separable. Otherwise, a promised good or service distinct from the other should be separated and identified with respect to individual performance obligation. Now, as I've said earlier, the key point here is issues that border on distinct goods or services. And I want somebody to read this summary point before I provide you with illustration. I will demonstrate whether we really have understanding of it.
The key point in distinct goods or services. A contract includes promises to provide goods or services to customer. Those promises are called performance obligations. A company would account for a performance obligation separately only if the promised good or service is distinct. A good or service is distinct if it is sold separately or if it could be sold separately because it has distinct function and a distinct profit margin. IFRS 15 states that a good or service that is promised to a customer is distinct if both of the following criteria are met. 1, the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. That is, good or service is capable of being distinct. And 2, the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. That is, the good or service is distinct within the context of the contract.
Okay, thank you very much. Now, I'll give you an illustration that tends to explain further our understanding of distinct goods and services. Okay, can we look at this illustration? Nudin, can you read the illustration and let us see who will provide guidance to it before I provide suggested solutions?
Illustration. Office Solutions. A limited company has developed a communication software package called ComSoft. Office Solutions has entered into a contract with Logisticity to supply the following. A, license to use ComSoft. B, installation service. This may require an upgrade to the computer operating system, but the software package does not need to be customized. C, technical support for 3 years. D, 3 years of updates for ComSoft. Office Solution is not the only company able to install ComSoft. And the technical support can also be provided by the other companies. The software can function without the updates and technical support required. Explain whether the goods or service provided to logisticity are distinct in accordance with IFRS 15 revenue from contracts with customers.
Okay, thank you. Who will provide guidance to this? Explain whether the goods or services provided to logisticity are distinct in accordance with IFRS 15. Okay. Let me see whether I can provide solutions to it. No comments?
Okay. Based on my understanding, I can say the goods and services is not a distinct goods. And my reason is this. There is a statement that said Office Solution is not the only company that's able to install ComSoft. And another thing is the software can function without the updates and technical support. In view of that, I will say this goods and services is not a distinct.
Are you not contradicting yourself? I think I did. Okay, go ahead. I can follow.
So I was about saying, for me, unlike Mr. Nuruddin, those points that I mentioned actually made it look like distinct for me, because this Office Solution was able to identify differently. I want to use the word distinctly the services that would the company is ready to perform, along with the software ComSoft that the company is selling. So I was then thinking that this license of use of ComSoft, installation services, technical support, 3 years update, not minding the fact that other people can provide it because it is a market, but because they were able to clearly identify those services, that makes it look distant for me.
Okay, who else?
Okay, the additional thing I would just say is that I agree with Asama that these services are distinct, because for it to be distinct, it means that they are separable, you know. And if you look at each of these 4 items, you know, they can be easily separated from each other and performed separately. So that is why I will agree with the proposition of Asama that it's a distinct service being offered by Office Solutions.
Now, Nuruddin, you gave us clue, but in your interpretation, probably interpreted
exactly. The interpretation is wrong. I get it clearly now.
Okay, can you read out what the suggested solution looks like?
Okay. ComSoft was delivered before the other goods or services and remains functional without the updates and the technical support. it may be concluded that logisticity can benefit from each of the goods and services either on their own or together with the other goods and services that are readily available. The promises to transfer each goods and service to the customer are separately identifiable. In particular, the installation service does not significantly modify the software itself, and as such, the software and the installation service are separate outputs promised by Office solution rather than inputs used to produce its combined outputs. In conclusion, the goods and services are distinct and amount to 4 performance obligations in the contract under IFRS 15.
Okay, thank you for that clarity now. Thank you for that clarity. Okay, now let's move further to other perspectives to this. Okay, now.
Can I quickly ask a question?
Okay, sir.
Yeah, for instance, if we buy a Microsoft package, and we get the Microsoft Word, Excel, access to Power BI, and also maybe some terabytes memory, cloud memory space, and several other things that comes with buying a Microsoft package. So each of those softwares, each of those accesses, can we consider them as distinct services that Microsoft is offering us, or we see them as a whole?
Okay. Can you go back to combination of contracts?
Okay. An entity shall combine 2 or more contracts entered into at or near the same time with the same customer or related parties of the customer and account for the contract as a single contract if one or more of the following criteria are met.
See, as what?
As a single contract.
Okay, if what?
If one or more of the following criteria are met.
Okay. Now, what are the criteria?
1, the contracts are negotiated as a package with a single commercial objective.
Does that answer that?
Yes, it does.
2,
the amount of consideration to be paid in one contract depends on the price or performance of the other contract.
Everything is lumped as one. There's no way you can, it's being commingled, there's no way you can separate it because even the time to which you have access to it is the same period. 3rd,
the goods or services promised in the contract or some goods or services promised in each of the contracts as single performance obligation in accordance with paragraph 8.
Now, single performance obligation means it will be delivered simultaneously at the same time. You have access to use PowerPoint, Word, everything at the same time, even shared office and all sorts of things. You use drives and etc. Does that make sense, sir?
Yes, it does.
Okay. Now let's look at three. Can somebody take us through this?
Okay, let me take this. Determining the transaction price, which is the step 3. The transaction price is the amount of consideration an entity expects to be entitled to in next stage of transferring the promised goods or services, not amount collected on behalf of third parties, e.g. sales tax or value-added tax. The transaction price may be affected by the nature, timing, and amount of consideration, and includes consideration of significant financial components, variable components, amounts payable to the customer, e.g. refunds and rebates, and non-cash amounts. Is that okay, sir?
Yeah, continue.
Okay. So the nature, timing, and amount of consideration promised by a customer affect the estimate of the transaction price. When determining the transaction price, an entity shall consider the effects of all the following. Which are variable consideration, constraining estimates of variable consideration, constraining estimates of variable consideration, the existence of a significant financial components in the contracts, non-cash considerations, and consideration payable to a customer. Okay. For the purpose of determining the transaction price, an entity shall assume that the goods or services will be transferred to the customer as promised in accordance with the existing contract, and that the contract will not be cancelled, renewed, or modified.
Okay, thank you. Now, what we are seeing is this. The transaction price, as we have said earlier, is the amount of consideration a company expects to be entitled to from the customer in exchange for the transfer of the promised goods and services, or services as the case may be. Now, this transaction price we are talking about will rather reflect the company's probability-weighted estimate of variable consideration, including reasonable estimate of contingent amounts based on constraints factor, which we'll discuss later, in addition to the effect of the customer's credit risk. Customer's credit risk at that point, not subsequent changes. Credit risk at that point and the time value of money, if it is material in amounts and in time. Usually, anything that is less than 1 year will barely build in material time value of money because it's still within that span. Okay, anything beyond 1 year, we always factor effect of time value of money, 1 year or above. Okay, now, if you remember, we said transaction price consists of fixed price, variable considerations, and your variable consideration are consideration that varies with future outcomes. And this may include things like discounts, may include things like rebates, may include refunds to customers, may include price concessions, may include cash discount that is factored ab initio to credit terms, and may include penalties you will pay as an entity to your customer for not meeting certain terms and conditions, probably delivery time or specification or quality. Now, the variable contingent amount are only included where it is highly probable, take note of it, where it is highly probable that there would not be a reversal of revenue. When any uncertainty associated with the variable consideration is resolved. What it simply means is this. There's this constraint factor that the IFRS introduced to IFRS 15 that says that not necessarily will all variable consideration be factored in determining the transaction price. Those that will be factored in are those that are not necessarily constrained with respect to contingency, where we won't have the situations that will have arose in recognizing revenue and later coming to reverse revenue because such conditions towards having entitlement to the variable consideration are not met. Which then implies that variable consideration that we recognize, apart from the fact that it will be probability weighted using the expected value methodology, it must be those that have high degree of probability and propensity to be collectible or earn as revenue from customers, unlike those that might be constrained in a situation where we have to reverse such revenue. And that's why the standard ensures that revenue is recognized only when it is highly probable that what you term as your transaction price is collectible in cash or is equivalent from the customers. Now, certain examples exist where a variable consideration can arise, as I've said earlier, where you give discount. Trade discount is obvious, but again, it might be trade discount you give in anticipation that there will be more purchases. And we're going to see a practical example of that, where trade discount is given, but it's not met immediately, but you have more or less estimated the degree of meeting such a consideration in the future. Rebates, refunds, price concessions, customer loyalty points, credits, and penalties. Now, take note of this again. Whenever you want to determine your transaction price, given from the definition that deals with the amount of consideration expected by a company to be entitled to from its customer for the transfer of goods or services to that customer, the entity must adjust that transaction price for the effect of time value of money if the timing of payments means that the transaction contains a significant financing component. What does that mean? If your normal cycle of trade is that people that buy from you by default have 30 days credit period, and those people, when you sell computer to them, you sell it for 500,000, 30 days credit. And there's someone that needed credit 60 days, which is an extended period. And you now decide to sell the computer at 550,000. What it means is that in determining the transaction price of 550,000, knowingly or unknowingly, scientifically or otherwise, you have estimated 50,000 as the financing component for paying after more than 30 days of the normal credit period that average customers are entitled to. Therefore, the 50,000 will not be treated as revenue. It's only 500,000 will be treated as revenue. While the 50,000 will be treated by way of unwinding of discount as finance income, because it arose for a financing arrangement. And we're going to see that. A single financing component may be explicitly stated in the contract, but in practice, they are barely stated explicitly in the contract or in the invoice, but they are implied in the payment terms in that contract. Are they implied sometimes? You see a company that will say, okay, if you are buying this laptop for 30 days, is 500. If you are buying for this, is 510. Directly, they're not telling you that they build up interest in it. They are just telling you that the price varies with time, which means impliedly, you are also aware that there's a financing component in it. The question then is, I'll give illustration. How do we identify a financing component, it exists or not, and how do we treat such a financing component? Okay. Madam Anne, can you read that illustration? No, I think your network is bad. Your network is, sorry, your network is bad. Can somebody else read it?
Taplop supplies on 1st July 20X5. Taplop entered into a contract with Trico to purchase.
Hello, it seems Nudi, your network is also bad.
No, let me try. The network is not.
$500 per unit. There's more than 500
laptops
in retrospectively.
Your network is bad. Okay, go ahead, Akifalayan.
Okay. Taplop supplies laptop computers to large businesses. On 1st of July 20X5, Taplop entered into a contract with Trico, under which Trico was to purchase laptops at $500 per unit. The contract states that if Trico purchased more than 500 laptops in a year, the price per unit is reduced retrospectively to $450 per unit. Taplop's year end is 30th of June. Okay, so A, as at 30th September 20X5, Trico had bought 70 laptops from Taplop. Taplop therefore estimated that Trico purchases would not exceed 500 in the year 20X6, and Trico would therefore not be entitled to the volume discount. B, during the quarter ended 31st December 20X5, Trico expanded rapidly as a result of substantial acquisition and purchased an additional 250 from Taplop. Taplop then estimated that Trico's purchases would exceed the threshold for the volume discount in the year 20X6. So those are the two scenarios. So required, calculate the revenue Taplop would recognize in 20X5, and B, the revenue Taplop will recognize in 31st December 20X5. First in September and the other in December.
Okay, who will answer that? Or who will first of all narrate what has happened? What has happened?
Okay, let me just read and re-narrate it because I didn't understand when I was reading it too. Okay, so the agreement is between Taplop and Trico for the purchase of 500 units of computers. So Trico is supposed to purchase 500 units of computers. But the other agreement was then that if Trico is able to purchase more than 500 units in a financial year, then the cost of the laptop will be reduced retrospectively to 450 and not 500. That is if he or she purchases, if Trico purchases more than 500 units. So the first part of the question is saying, as at 30th of September, that's 3 months from the agreement date, Trico had bought 70 units of the computer. Taplop then estimated that Trico will not exceed the 500 agreement as at the financial year. and TRICO will therefore not be entitled to the discounts. So that is the first observation. But the second part says, during the year December 30 exercise, that is 6 months after agreement, TRICO expanded as a result of substantial acquisition and purchased an additional 250 laptops from Taplow. So I believe this is additional 250 from 70, from the earlier 70 boards. Taplow then estimated that TRICO purchases would exceed the threshold for the volume so that it will be qualified for the discounts by 30th 20x6. So the question is then asking for the first part, under how much will you recognize as revenue as at 30th September 20x5?
Okay. Let us now start to build little model for this. Okay. Okay. Let's pick out our variables. On 1st of July, 2015, there was a contract. A contract entered into. And the transaction price per laptop was $500. Let me assume we are dealing with Naira, or let me even put the actual currency dollars there. Okay. The contract states that if TRICO purchased more than 500,000, the price is reduced retrospectively to $450 per unit. Please underline this. The agreement did not say that once it clocked 500, any additional, it will have a reduced price. No. What the agreement says is that once he's able to buy up to 500 in that year, even if he has paid $500 before, they will retrospectively give him back a rebate of $50 per, because the difference between the reduced price and the initial price is $50, which means the word reduced and retrospective is key to our discussion. Now, which means reduced price, if condition met, is $450. Therefore, implied rebates or discount, as the case may be, is how much? The difference between 500 and 450. Next, as at 30th September 2015, that's just how many months? That's 3 months into the contract.
3 months.
After. Quantity units purchased by 2 was how much? 70. And condition expected not to have been met over or in a year, which means they told us that the condition that because they projected the sales, it's unlikely that it will meet it. That's what that means, Abi, from the expression given to us here. Now, but things change 3 months after. As at 31st of December 2015, which is 6 months after the contract was initiated. What happened? Unit purchase was 250 addition. I'll put it incremental, which means it's not that everything is 250, but just that quarter was 250. But condition expected to be met in a year, which means there's a green light here. I'll put green. Why there's a red light here? I'll put red. Now, the question then is, calculate revenue. Revenue, be it portion of transaction price to be recognized in quarter 1. That quarter 1 is between 2015 and 30th September 2015. Okay. Now, if that is the case, here, the transaction price that we are going to adopt will remain at 500 because of what? Because of this condition that expect that it won't be met, which means it won't be able to benefit. Okay. And what is the quantity? Quantity sold. Quantity sold is 70. Therefore, our revenue will be products of $500.70. And that gives me 35,000. Okay. Now, what will I recognize between 1st of October and 31st of December? The transaction price, though, was 500. But because this condition has shown that though what they have purchased so far is 70 and 250, which when you add these two together, let me borrow a shape here. When you add these two together, what it gives you is 70 plus 250. 70 plus 250. That's 320. Probably this estimated 320 has shown that you are going to 500 in the whole year. 320 is more than half. Therefore, it's more likely that you will meet it. Probably that was the consideration that made them make this judgment call. Which that means that I will have to adjust for the rebates or discounts, depending on the terminology adopted. And that is how much? The 50. Remember, rebate was the difference between the $500 and the $450. And what then do you have? You have the adjusted transaction price of how much? Of 450. Now, when I do that, revenue, I'll now view revenue from two perspectives. First perspective, incremental sales in Q2. And that is 450 multiplied by 250. Which is this? Remember, quantity sold was 250. Therefore, this is the amount. Now, but 2, I'll have to reduce prospectively for the discount or rebates for Q1, which was not enjoyed by the customer before now. Which means what the customer will pay will be reduced by, this only capture for 250. And they told us that whenever we examine, even if you have paid 500 before, once you are more or less likely going to enjoy that discount because you have met or you will meet certain conditions in terms of quantity discount, you will retrospectively get back your money. And it has gotten to a level where we expect that it will get back its money. And we'll do that and say, okay, how much was it? The discount will also be enjoyed on this 70. It means 35 will be deducted. Therefore, the actual revenue for Q2 will be this net of that discount, which will give me 109. And this is what's supposed to be. Does that make sense? Does that make sense? Now, take note, if the condition is that it is only when you cross the 500 mark that further purchases will get discount, the treatment will be different. Remember, you look at the substance of the transaction. If I agree with you that if you purchase 500 cumulatively from me, thereafter, anything you purchase will have discounts of 10%. If I'm recognizing revenue for the first 500, it will be at full amount. It is the subsequent amount that might likely enjoy discount. Okay, now let me bring the wording of the solution so that you can look at it with reference to the model I built, and let us see whether it makes sense. Over to you. Who will assist us to review the model? Can somebody read it now? Who will volunteer? Who will volunteer? And do you have a better network now? Do you have a better network? It seems not. Okay, Shagun, can you proceed?
Okay, I will read from here. Applying the requirement of IFRS 15 to 3Co's purchasing pattern at 30 September 20x5. Taplop should conclude that it was highly probable that a significant reversal in the cumulative amount of revenue recognized that is $500 per laptop, would not occur when the uncertainty was resolved, that is, when the total amount of purchases was known. Consequently, TAPLOP should recognize revenue of 70 times $500, which is equal to $35,000 for the first quarter ended 30th of September 20x5. B, in the quarter ended 31st December 20x5, TRICO's purchasing pattern changed changed such that it would be legitimate for TAPLOP to conclude that TRICO's purchases would exceed the threshold for the volume discount in the year to 30 June 20x6, and therefore that it was appropriate to reduce the price to $450 per laptop. TAPLOP should therefore recognize revenue of $109,000 for the quarter ended at 1st December 20x5. The amount is calculated as from $112,500, that is 250 laptops times $450, less the change in transaction price of $3,500, that is 70 laptops times $50 price reduction, for the reduction of the price of the laptop sold in the quarter ended 30th September 20x5.
Thank you very much. Any other questions?
Hello, comrade. Yeah. This is not a question, but my observation, because the way the question was structured, I got confused. I don't know if anybody shared the same opinion. It was my thought that the question is actually speaking to actual and not expectation of purchases. Though while I understand the treatment because of the expectation part, but I thought the question was speaking to actual and not expectation.
What do you mean by actual and not expectation?
Okay, the line reads, if TRICO purchased more than 500 laptops in a year, the price per unit is reduced retrospectively. Yes. That is one. Then in the B part, it then says that during the quarter ended December 20x5, TRICO expanded rapidly as a result of substantial acquisition and purchased an additional 250 laptops. That is where I didn't get clearly. Now, we treated it based on the expectation. I get that.
True. Yeah. Now, what you are trying to say is that you should have waited until clock 500 so that you are sure.
Hey, maybe the question would have given us a C.
No. It's not the question I'll give you. It speaks to the fact that, let me take you back to our discussion so far. It now speaks to the fact that something was not, you didn't capture something well. Can you read this first paragraph here? The transaction price.
Okay. In step 3, the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for goods and services. The transaction price would reflect the company's probability, weighted estimate of variable consideration, including
what is a variable consideration?
Okay, the portion that which you have achieved.
Read variable consideration here. Second paragraph.
Variable contingent amounts are only included where it is highly probable that there will not be a reversal of revenue when any uncertainty associated with the variable consideration is resolved.
Example.
Okay, example. Example of where a variable consideration can arise include discount, rebates, refund, price, concessions, credit, and penalties. Okay.
Does it make sense?
That first paragraph, it answered my question. Thank you, sir.
Thank you. Okay, now let's look at this next question. Who will read this for us?
Okay, I will read. On 30th December 2007, Lansdale sold product X to a customer for $12,100, payable 24 months after delivery. The customer obtained control of the product at contract inception. The cash selling price of product X is $10,000, which represents the amount that the customer would pay upon delivery of the same product sold under otherwise identical terms and conditions as at contract inception. The cost of the product to Lansdale is $8,000. Required, explain how Lansdale should account for this transaction.
Can you explain what has happened?
So if I can explain, the product X is transferred to the customer at the inception of the contract. And it was transferred for an amount of, it was sold for $12,100. But, you know, if the the contractor take control to the products at the inception, the car selling price, the selling price actually is $10,000, which represents the amount the customer would pay upon delivery of the same products under same identical terms and conditions at contract inception. The cost of the Lansdale is. So what I can see here is that there's an element of finance costs that are being.
You use the right terminology. Financing arrangements.
Okay, financing arrangements, because.
You know, financing arrangement has two sides to the coin. Side to the person providing that finance, it will create finance. Side to the person enjoying that finance, like a borrower, it creates finance costs. Therefore, okay, just to do the right terminology, it has created financing arrangements.
So okay, it has created financing arrangements. So the customer is going to pay at a premium to the normal selling, to the standalone selling price.
You are missing the terminology again. It's not paying premium. You have said it's financial arrangement, therefore it can't be paying premium. You know, when you say customer pay premium, we'll get to that level. Premium means like that product is a luxury product that you are ready to even put more to acquire it than any other person getting it.
Okay. That is premium. I understand the idea now.
Financial arrangement is not premium. Let's watch those things.
Okay, the whole idea I'm trying to pass across is that the customer is paying higher than the standalone selling price, which is the amount that it would have been. And this is as a result of the timing of when.
Because it's getting an extended credit term.
Yes.
Which means it's like what has happened here is that it's a 2-in-1 transaction. I am the one selling goods, and I'm the one that provided you money to come and buy it from me. After buying it from me, you become a debtor to me by way of borrowing, which will attract what? Interest. That is what makes the other component part of the contract to be a financing arrangement. And what do we do in that situation when you have this? Remember, we talk about combined contracts. Do you guys see now?
Yes.
And if you go back to our discussion, here also, we talked about something like that. Can you remember? Combined contract. Have you? Do you get what I'm saying now? Now,
excuse me.
Yes.
So am I correct to say that this kind of contract will be treated separately?
Yes, sir.
Oh.
If you remember, we discussed something here. Can you read it again? Shegun, you are the one that is breaking down the question. Can you read this section again? Contract with customer may be partly within the scope of this standard.
Okay.
Read it again.
A contract with a customer may be partly within the scope of this standard, that is IFRS 15, and partly within the scope of other standards listed in paragraph 5. If the other standards specify how to separate and or initially measure one or more parts of the contract, then an entity shall first apply the separation and or measurement requirements in those standards. An entity shall exclude from the transaction price the amount of the parts or parts of the contract that are initially measured in accordance with other standards, and shall apply paragraph 73 to 86 to allocate the amount of the transaction price that remains, if any, to each performance obligation within the scope of this standard, and to any other parts of the contract identified by paragraph 7b. If the other standards do not specify how to separate and or initially measure one or more parts of the contract, then the entity shall apply the standard to separate and or initially measure the parts or parts of the contract. Then the entity shall apply this standard to separate and or initially measure the parts or parts of the contract.
Now, the question we are solving now, we identified that there's a revenue part which falls under the standard, and there's financing arrangement part which falls under IFRS 9. Is that not?
Yes.
Now, what we do is that first, under IFRS 9, how does it require us to measure a financing arrangement? And if we have basis of doing that, we can use that basis to separate the transaction price relating to financing arrangement from that relating to what's it called? This product's what's it called?
To the product sale.
The revenue from sale of goods here. Secondly, if that standard does not give us clear basis of separating it, we'll now revert to this standard and say, okay, do we have a standalone price or any other methodology that we can adopt to separate the revenue associated with the transaction price such that the residual will be that of the financing component? Now, to answer this question, we'll go back to our model. We'll build a model for it. This is the question, Abi. Let's extract our information. Transaction date. First, 31st of December, 2017. Transaction price. A combined contract. Remember, they are combined contracts. $12,100 in dollars. Cash price, if it's on cash and cash basis, was 10,000. Inventory cost price, inventory. That means it cost the company how much? 8,000. But naturally, it's always sell on cash and cash basis for 10,000. Settlement date. Settlement date is 24 months, have you? Okay, 24 months will be exactly 31st December 2019. That's 2 years. 24 months after. Okay. Now, How do we separate? Step one is to allocate the transaction price to the separate embedded contracts. I use the word embedded because it's still a single contract, but having multiple contracts in it. Now, how do we do that? Because we don't have a basis to use IFRS 9 to separate this, because where only IFRS 9 gave us guidance to separate it if it's embedded derivatives and some other things like that. Therefore, IFRS 9 rely much more on us here to look at our standalone price or any other requirement that can make us separate. And easily, we have a standalone price. This cash price is a standalone price under the condition of normal course of business. Therefore, given the standalone of cash price, how much? $100. Hence, the residual approximates the finance, the face value of the borrowing. Sorry, let me, the residual approximate the financing income. Let me use that language of the arrangements, which means the whole sum is 12.1. The difference between 12.1 and 10,000 will give me this. And that is my residual, which is the balancing figure. Now, that's step one. Step two is that revenue is recognized upon transfer of promised goods, which was made on as of 31st December 2017. This revenue will be recognized. Will be 10,000. And in that light, the accounting entry will be debit and credit. What will I debit? Debit my trade receivables, and credit my revenue. Now, step three. recognition of the financing component. Now, I'll rely on the measurement requirements of IFRS 9 that borders on amortized cost measurements. I'll ask myself, what is the face value of the entire transaction? What's face value of the transaction price? Let me call it that language. Let me call it transaction value or consideration, so that I can qualify it by not using the word transaction price. That is this. What is my present value, which is my cash price? If there's no financial arrangement, which means there's no effect of time value of money, is 10. Therefore, I'll now look for my implied rate of return, which is simply as IRR, or discount rate, that over 24 months, which is 2 years, we approximate, will make 10,000 to become 12,100. Therefore, we can use those Excel formulas we are used to. Who can tell me which of the formulas would be much more appropriate to use?
We can use goal-seek.
No, goal-seek is too much for this. Goal-seek add more value to those that are critical than this one.
Then alternatively, we can use the IRR formula in Excel.
No, the easiest one to use is the rate function. You forgot it. The rate function. Therefore, the rate function what is my number of payments? 2. Let me count how many years. Year count. The year count, which exact function can I use for year count? Date difference, date diff. I'm looking at the difference. I'm looking at the difference between the transaction date and the settlement date, and I want to know it in years. Y stand for years in the code. Therefore, that is 2 years. Therefore, I'll come here and say the rate function number of years, 2. Payments, there's no intermediate payments. Present value is 10,000. Future value, present value is 10,000. Future value is, present value is 10,000. Future value is 12,100. What type is at the end? Okay. What does that give me? It give me 10%. Let me see whether it's exactly 10%. Okay, it's exactly 10%. Okay, now this 10%, I'll now construct my amortized schedule. Okay, I think I have one before. Let's see. Okay, I can construct it afresh. Yeah. Amortized cost at the start. Interest based on 10%. Because there's no periodic payment, there's no cash flow. And amortized costs at the end. I only do it for 2 years. Year 1 and year 2. This is 10,000. And this 10,000 will be increased by interest rate of 10%, multiplied by the opening balance. And the closing balance is 100. You just bring it down, which means invariably the financing component, which is 2,100, this finance component, which is 2,100, how do we recognize it in each year? In each year, year 1 and year 2. We recognize what? Debit to trade receivable, which is also a component of trade receivable itself is a financial instrument, is a financial asset, if you remember, and debit finance income, which is profits or loss. Okay. That is that. Any question on this? Any question on this? Any question? Now, if there's no question, now let me show you the summary of the solution in descriptive terms and see how it aligns with what I've modeled. Can somebody read it up?
Okay. The contract includes a significant financing component since there is a difference between the amount of the promised consideration of $12,100 and the cash selling price of $10,000 at the date the goods are transferred to the customer. In the year ended 31st December 2007, Lansdale should record revenue and a related receivable of $10,000 for the sale of product X. Interest income on the receivable should then be recognized in the years ended 31st December 20x8 and 20x9 at the effective interest rate based on the contract terms of 24 months in accordance with IFRS 9 financial instruments.
Okay. Now, I think we'll go for a short break and we'll continue to discuss other critical aspects of step 3. Step 3 has a lot of key considerations that we need to take into effect, especially for the variable considerations. Okay, now we have to look at variable consideration from different perspectives, and let's discuss it before we move to step 4. Okay, any other question? Okay, we're back. And in continuation of our discussion, we'll now enter into discussing on critical areas as regard to determining the transaction price. And this area border more on variable consideration, where we'll be considering it from a simple basis. And also, in addition to that, where we'll be looking at the constraint factor in determining variable consideration. Okay, and let's move ahead with this introduction to that. Okay, I want somebody to more or less live up our expectations to what we'll be discussing with respect to estimation of variable consideration. Who will volunteer?
I will. Estimating variable consideration. Variable consideration. Requirement to estimate variable consideration. General. If the consideration includes a variable amount, the entity is required to estimate the amount of consideration to which it will be entitled in exchange for transferring the promised goods or services to the customer. When estimating the amount of consideration to which it is entitled, an entity needs to consider the variable consideration constraint. Identification of variable consideration. Examples of variable consideration include discounts, rebates, refunds, credits, price concessions. See example 7.3.1. Incentives, performance bonuses, and penalties. Consideration can also vary if entitlement to the consideration is contingent on the occurrence or non-occurrence of a future event. Examples include a product sold with a right of return or a fixed amount promised as a performance bonus on achievement of a specified milestone.
Okay, we've discussed that some of this before. Okay, now let's look at issues that give rise to penalty in variable consideration.
Okay, penalty gives rise to variable consideration. An entity enters into a contract with a customer to build an asset for 1 million CU. In addition, the terms of the contract include a penalty of 100,000 CU if the construction is not completed within 3 months of a date specified in the contract. The entity concludes that the consideration promised in the contract includes a fixed amount of 900,000 CU and the variable amount of 100,000 CU arising from the penalty. The entity estimates the variable consideration in accordance with IFRS 15 and consider the requirements in IFRS 15 paragraph 56 to 58 on constraining estimates of variable consideration.
Now, okay, the issue here is this. You enter into a contract of construction, and the contract is such that 1 million is the contract amount. And in the contract, it was agreed that there is a penalty if you fail to deliver at a specified date. And the penalty is 100,000 out of 1 million. What IFRS 15 is saying is that there are 2 performance obligations involved in this. Who can identify the 2 performance obligations in clear terms? Who can recognize the 2 performance obligations in clear terms?
Okay, I think the 2 performance obligations here. Number 1, the construction will be completed. And number 2 is there is specific date that this construction is expected to be completed.
Okay, the first is issue of the construction of the building. Let me use the word construction. Can we mute? And 2, I think I didn't write the building well. And 2, delivery time or timing in terms of expedition. What it means is, naturally, if the customer expects you to delay on the contract for 4 months, let's say instead of 3 months, it's 4 months. Such contract, you will have priced it for 900,000. That's what it means. But because you want you to do it in 3 months, that's why he has committed to pay you 100,000 to make it 1 million. And peradventure, you fail to meet up that 3 months, is collecting back the 100,000. That is the way we have more or less conceived the splitting or the identification of the performance obligations. Does it make sense?
Yes, it does.
Okay. Now let's look at another perspective. Can you read this? Okay. Let's look at this.
Okay. 1st December 20x1.
Okay, hold on, wait, I'm coming. Before then, I want you to look at consideration that varies based on future market prices. Just hold on. Okay, you can proceed.
Consideration varies based on future market prices. Pricing that varies based on future market prices after the performance obligation has been satisfied, and thus the vendor has a receivable, not a contract asset, is not considered to be variable consideration as described in IFRS 15, paragraph 50 to 52. IFRS 15, paragraph 108 states in part, a receivable is an amount, is an entity's right to consideration that is unconditional. A right to consideration is unconditional if only the passage of time is required before payment of the consideration is due. An entity shall account for a receivable in accordance with IFRS 9. Therefore, until the point in time when no future events other than the passage of time needs to happen before the payment of consideration is due, and consequently the right to consideration becomes unconditional, the contract with the customer remains within the scope of IFRS 15, and therefore any variability in the transaction price is treated as variable consideration, and the constraint on estimates of variable consideration is applied as required. From the point in time when payment becomes unconditional, the receivable should be accounted for under IFRS 9 in accordance with IFRS 15, paragraph 108, and requirements of IFRS 15 regarding variable consideration no longer apply. For example, entity A enters into a contract with customer B to deliver a specific quantity of copper concentrates to customer B on 1st December 20x1. When the specified quantity of copper concentrate has been delivered to customer B, entity A's performance obligation is satisfied. The final price will be based on the London Metal Exchange LME copper price 3 months after the date of delivery, that is 28 February 20x2, to coincide with the timing of payments from customer B. Entity A's right to receive payment from customer B is unconditional as at 1st December 20x1 because entity A has satisfied its performance obligation at that time by delivering the copper concentrate. Nothing else other than passage of time needs to happen before payment of the consideration is due. Changes in the price of the copper concentrate between 1st December 20x1 and 28 February 20x2 do not affect entity A's right to receive payment, even though the amount that entity A will receive is known only on the payment date. Consequently, when entity A delivers the copper concentrate on 1st December 20x1, it should recognize a trade receivable under IFRS 9.
Okay, thank you. Now, what are we trying to drive at? Now, it's also possible that you enter into a transaction. Let me start with a transaction like you deliver goods to someone, and what you have agreed in that transaction is that upon delivery of such goods, payment will be made in future, but instead of that payment to be absolute of, let me say, $10,000, you now say that payment is referenced to a market index or future market price of that item. as at the time is to pay. This transaction is common in crude oil trading and some other trading that's much more based on future forecast and some other things like that. Now, if that is the situation, we are not saying that will revenue be impacted by such, given that the promised goods has been delivered. IFRS 15 understand that what's revenue is the fact that you have received cash or you have receivable at hand. If you have received cash, therefore this issue of future price is not even coming because it has been settled off. But if it is receivable, that's when likely this future market price might impact it. And what is receivable? From the definition of the standard. Let me share it once again and see what receivable is all about from the standard perspective. Now, receivable, from the perspective of an entity, is the right to consideration that is unconditional. The only thing that is left is as a result of the passage of time, just waiting for the due date. No condition need to be attached to it. Which then means that in that regard, revenue that create a receivable at the point the performance obligation has been satisfied will not be affected by way of changes in future prices. Rather, such changes in future prices will be treated along with that variable with respect to the requirement of relevant standard. The question then is, what is the relevant standard in this case? The relevant standard in this case will be nothing other than the standard that account for financial assets in which the receivable belong. And that's what we are saying. Which then means that the revenue will at no point be affected by such changes in the amount of receivables subsequent to when the performance obligation has been satisfied. But if the performance obligation probably is satisfied over time, it may be probable that such may affect, and it will only affect at the point in which the performance obligation is being satisfied. Any subsequent effect of such will not affect your revenue recognition, even though it may affect receivable in that light. Does that make sense to anyone? Does that make sense to us?
Yes.
Okay. Now let's look at what method exists in estimating variable consideration. What method exists? The standard identified two methods, and we are going to look at those methods. And what determines the method to use? Is it just a policy option? Or is it an option that is much more triggered by what will be a better reflection of the commercial substance of the transaction between the entity and its customer? Can somebody lead us in this discussion?
Selection of method for estimating variable consideration. The method an entity uses to estimate variable consideration is not a free choice. An entity should use whichever method will better predict the amount of consideration to which it will become entitled. When a contract has only two possible outcomes, it will often be appropriate to estimate variable consideration by using a method based on the most likely amount. When the entity has a large number of contracts with similar characteristics, and the outcome for each contract is independent of the others. The expected value method may better predict the overall outcome for the contracts in aggregate. This will be true even when each individual contract has only two possible outcomes, that is, a sale with a right of return. This is because an entity will often have better information about the probability of various outcomes when there are a large number of similar transactions. It is important, however, to consider carefully whether the outcome for each contract is truly independent of the others. For example, if the outcome is binary but is determined by the occurrence or non-occurrence of the same event for all contracts, that is, the variable amount will be received either for all That is, the variable amount will be received either for all of the contracts or for none of them. The expected value is likely to be a good predictor of the overall outcome, and the entity may need to use the most likely amount method to estimate the variable consideration in the contract. For example, each year, entity X performance is ranked against that of its competitors in a particular jurisdiction. All of entity X's customer contracts specify that a fixed.
Okay, sorry. You can proceed.
Okay, all of entity X's customer as customers contract specify that a fixed bonus of 500 CU will be due to entity X if it is ranked in the top quartile. Entity X has approximately 1,000 customer contracts. Entity X should estimate the variable consideration on the basis of the most likely amount. Although Entity X has a large number of contracts, the outcomes are not independent because they all depend on the same criterion, that is the ranking of Entity X against its competitors. Then bonus will be payable either in respect of all the contracts or none of them. Therefore, the overall outcome for the contracts in aggregate will be binary, and the expected value will not be a good predictor of that overall outcome.
Okay. And that explains it to us in the term to which it was given. Okay. Any other question on that? Any question? Any question on that? Okay. Okay, let's continue. From where we stopped, estimating variable consideration Estimating variable consideration. Can be done from two perspectives, or there are two methods involved. Two methods. The first method deals with the expected value. Okay, and the second method, this majorly with, how would I call it? When you look at for most likely outcome. Okay, now let me give you the description. Two factors explain what expected value method is. One, it is probability weighted. Two, it is used for population in sense of wide spectrum, which means when you have more data, and by more data population, expected value tends to be the most appropriate representation. And this same thing will be discussed when you get to IFRS 7 in terms of how do you estimate provision. Most likely outcome is less of sarcastic. Less of, let me say, probability modeling. Stochastic. And it is more of, or it tilts towards deterministic modeling. And two, it deals with two or very little options or alternative being available, given the small distribution of data. For example, in a binary option of 0 and 1, you use more of most likely, which means, is it more likely that it will happen or it will not happen? Which means, if it's more likely to happen, your base of estimation will be close to the value if it happens. And if it's unlikely that it will happen, it means you don't recognize it at all. But for expected value, you look at various states of the world, state of nature, various distribution, and you allocate probability weight to it of the likelihood of occurrence. And such is usually influenced by historical data, subject to adjustment for current condition related to information and future expectations. But what matters here is that the standards allow for any of these methods, but it's not a choice that is driven by just sentiment or judgment, but it's much more driven by what will likely reflect the true position of what is receivable as consideration from such satisfaction or for you delivering on your promised goods or services by way of performing on your obligation. And that is what the standard tends to portray to us. Any question? Now, I'll give you a practical demonstration of that as it's contained in the standard. Now let's look at this consideration. And this will give us some clear thoughts about its practical application. This example is as more or less provided for in Deloitte manual, which also is in tandem with what is contained in the standard. If you go to the standard, illustrative examples in this main standard, which you guys have copy of. Can somebody proceed on it?
An entity enters into a contract with a customer to build a customized asset. The promise to transfer the asset is a performance obligation that is satisfied over time. The promised consideration is 2.5 million CU, but the amount will be reduced or increased depending on the timing of completion of the asset. Specifically, for each day after 31st March 20x7 that the asset is incomplete, the promised consideration is reduced by 10,000 CU. For each day before 31st March 20x7 that the asset is complete, the promised consideration increased by 10,000 CU. In addition, upon completion of the asset, a third party will inspect the asset and assign a rating based on metrics that are defined in the contract. If the asset receives a specified rating, the entity will be entitled to an incentive bonus of 150,000 CU. In determining the transaction price, the entity prepares a separate estimate for each element of variable consideration to which the entity will be entitled using the estimation method described in IFRS 15, paragraph 53. A, the entity decides to use the expected value method to estimate the variable consideration associated with the daily penalty or incentive, that is 2.5 CU plus or minus 10,000 CU per day. This is because it is a method that the entity expects to better predict the amount of consideration to which it will be entitled. B, the entity decides to use the most likely amount to estimate the variable consideration associated with the incentive bonus. This is because there are only two possible outcomes, 150,000 CU or 0 CU. And it is the method that the entity expects to better predict the amount of consideration to which it will be entitled. The entity considers the requirement of IFRS 15, paragraph 56 to 58 on constraining estimates of variable consideration to determine whether the entity should include some or all of its estimates of variable consideration in the transaction price.
Okay, thank you very much. Now let's look at a situation where we need to distinguish between the estimation of variable consideration for expected value method based on similar contracts and how we apply it in a portfolio of contracts. If you remember, we talked about it before the session started in the video we watched together, where one of the critical aspects of applying this standard is that technology plays a role in doing this, especially where you have tens of thousands or hundreds of contracts, which you cannot treat on a one-on-one basis in that magnitude. And therefore, what do? You treat them as a portfolio of contracts. And it's easily done by way of technology. Okay, now let's put technology aside. The question then is, what guidance exists to distinguishing between estimation of variable consideration for expected value method based on similar contracts. How do we go about it? And also try to look at what the transition group proposed sometimes in 2015 about the way and manner to which you could approach that. And that's what we're going to look at for now. Can somebody read this up for me?
Distinction between the estimation of variable consideration for expected value method based on similar contracts and application of IFRS 15 to a portfolio of contracts. When an entity has concluded that the expected value method is appropriate to determine variable consideration for a specific contract, it may consider evidence from other similar contracts to estimate variable consideration. As discussed by the TRG in
the transition group.
Okay, the transition group in July 2015, when considering historical experience of similar contracts for the purpose of estimating the expected value of variable consideration for a specific contract. An entity is not applying the portfolio practical expedient as discussed at 3.4. Importantly, this means that the restriction on use of portfolio practical expedient in IFRS 15 paragraph 4, that is, that the entity does not expect the result of applying IFRS 15 to a portfolio of contracts with similar characteristics to be materially different from the results of applying the guidance to the individual contracts in the portfolio does not apply.
Okay. Now let's also look at situation where the amount you determine using expected value may not be a possible outcome of an individual contract, which means using expected value may not be appropriate in that situation. Rather, it will have been more appropriate to use the most likely outcome. Now let's look at that.
Amount determined using expected value may not be a possible outcome for an individual contract. In some scenarios, when using a portfolio of data to estimate variable consideration using the expected value method, the amount determined may not represent a possible outcome of an individual contract. However, as discussed by the TRG in July 2015, the fact that the expected value is not possible outcome for an individual contract is not a factor that should be considered in selecting the most appropriate method. Therefore, the expected value method can be used when using a portfolio of data to estimate variable consideration, even though the amount determined may not represent a possible outcome of an individual contract.
Which means, naturally, if expected outcome does not reflect possible outcome of an individual contract, it shouldn't be used. But if it relates to a population, okay, or a portfolio of data, as I said earlier, it will approximate that value because it's going to be like a net off on an average. Do you get what I'm saying now? And that is when it can only be used, even when individually it does not represent, which means it's expected that there will be offsetting. It's like probability that if you toss a coin multiple times, hundreds of times, the amount of tail and the amount of head should be equal because of large distribution of data. If you look at the principle of random outcome or randomization, okay, that's something that has allowed us to take as surrogate or perfect substitute the expected value method for a population, or what I can describe, population with wide spectrum is what I can also describe as portfolio of data. Or portfolio of contracts, as the case may be. Now let's move further. How do you determine expected value method, expected value method for variable consideration using a portfolio of data. Let's look at for how that can be easily demonstrated with our little understanding. Akin Folarin, can you move on from here?
Amount determined using expected value may not be a possible outcome for an individual contract.
No.
In some scenario.
Sorry, I think I didn't share my slide. Over to you.
Okay, so this is expected value method to estimate variable consideration using a portfolio of data. Okay, an example, entity B enters into a contract for the sale of product X for CU50 to customer C. Entity B's policy is to allow unused products to be returned within 30 days for a refund. Okay, therefore, the contract includes a variable consideration. In addition to the transaction with customer C, entity B has a large number of similar sales of product X, that is homogeneous population of contracts with the same right of return. When selecting the method to use to estimate variable consideration in accordance with IFRS 15, paragraph 53, entity B concludes that the expected value method will better predict the amount of consideration to which it will become entitled. Using the expected value method, entity B considers a portfolio of historical data which includes contracts for the sale of product X. Entity B concludes that this historical data is relevant and consistent with the characteristics of the contract with customer C. The portfolio of data indicates that 10 out of every 100 products were returned. Using the portfolio of data, entity B estimates the expected value for the sale of product X to customer C to be CU45, that is CU50 minus the 10% of CU50. The estimate of CU45 is likely to be consistent with the ultimate resolution of the uncertainty with respect to the product's right, considering the overall population. This is because when there is a large number of similar transactions, that is a homogeneous population of contracts, the entity's expectation of the amount of contribution to which it will be entitled is better predicted by preference of the probabilities of outcome exhibited by the portfolio of similar data. Okay. Entity B will separately need to consider whether its estimate of variable consideration should be constrained in a manner consistent with the logic for measuring variable consideration at expected value. That assessment should consider, that assessment should consider what amount of variable consideration should be included in the transaction price, such that it is highly probable there will not be a significant reversal of revenue on the basis of the homogeneous population as a whole. Note that when considering whether the variable consideration should be constrained, the entity is not required to consider the most likely amount to be received because it has already concluded that the expected value method is appropriate for estimating revenue for this specific contract.
Okay, thank you. What this demonstrated is that expected value method is more appropriate for portfolio of data, okay? All because it will offset one against the other, okay? But where you have small data structure, it will be more appropriate, depending on the situation, to make use of the most likely outcome. That is a representation of the variable consideration for each individual or for individual contracts in that respect. Okay, now let's look further to selected method for estimating variable consideration that will be used throughout a contract. Okay, Nuruddin.
Okay. It will become entitled. Using the expected value method, entity B considers a portfolio of historical data, which includes contracts for the sales of product X. Entity B concludes that this historical data is relevant and consistent with the characteristics of the contract with customer C. The portfolio of data indicates that 10 out of every 100 products were returned. Using this portfolio of data, entity B estimates the expected value for the sales of product X to customer C to be 45 CU, that is 50 minus 50 CU multiplied by 10%. The estimate of 45 CU is likely to be consistent.
It seems, yeah, I think you are not, this is what I wanted to read. Selected method for estimating variable consideration to be used throughout the contract. Okay, it seems you are repeating what has been narrated by Akin Folarin. Can you proceed to read this now?
From selected method for estimating variable consideration to be used throughout the contracts. One method should be used consistently throughout the contract when estimating the effect of an uncertainty on an amount of variable consideration to which the entity will be entitled. All the information, historical, current, and forecast, that is reasonably available to the entity should be considered in assessing the amount of variable consideration, and a reasonable number of possible consideration amounts should be identified. This information would typically be similar to the information that management uses during the bid and proposal process, and in establishing prices for promised goods or services.
Okay, as I've explained earlier, all what you consider is reasonable number of different factors, such as historical, current, and forecast, as it's expected to exist from management judgment or consideration. Okay, now furthermore, what happens when we are exposed to using more than one method to estimate variable return within a single contract when there are multiple elements of variability? Let us see that. And these are more or less practical considerations, which they are not day-to-day experience. Shagun, can you proceed?
Okay, using more than one method to estimate variable consideration within one contract when there are multiple elements of variability. When a contract contains multiple elements of variability, an entity is permitted to use more than one method, that is the expected value method and the most likely amount method, to estimate the amount of variable consideration to be included in the transaction price. Example 21 of the illustrative examples accompanying IFRS 15 shows that an entity should prepare a separate estimate for each element of variable consideration in a contract, that is for each uncertainty, by using either the expected value method or the most likely amount, whichever method better predicts the amount of consideration to which it will be entitled. Because IFRS 15 paragraph 54 requires entities to apply one method consistently to each variable element throughout the contract, it would not be appropriate to switch between the most likely amount and the expected value amount for a particular variable element during the life of a contract. An entity should also consider the guidance of IFRS 15 paragraph 56 to 58 on constraining estimates on variable consideration to determine whether it should include some or all of the variable consideration in the transaction price. For example, Entity X, an information technology service provider, enters into a contract with a customer to develop the customer's website to induce Entity X to complete the project on a timely basis and to provide a solution that drives business growth for the customer. The fee receivable by Entity X under the contract includes both fixed and variable consideration, which is determined as follows. The first element of the fee is based on the performance of the website and is determined by using a sliding scale from 500,000 CU to 1 million CU. The amount earned is based on a formula that uses, let's scroll up. Can you scroll up, please? Okay, the amount earned is based on a formula that uses a number of metrics, e.g., the number of pages viewed and the number of unique visitors, measured over the 2-year period after the website is completed and fully functional. The second element of the fee is based on the timely completion of the website and is determined as follows. 750,000 CU if the website is completed and fully functional within 90 days of signing the contract, or 350,000 CU if the website is completed and fully functional more than 90 days after the contract is signed. Having considered the guidance of IFRS 15, paragraph 53, on selecting an appropriate method for estimating the amount of variable consideration, Entity X applies the following methods to each element of variability in the contract. The amount of consideration related to the performance of the customer's website is estimated by using the expected value method because Entity X estimates that it could be entitled to a wide range of possible consideration amounts, any amount between 500,000 CU and 1 million CU. And 2, the amount of consideration related to the timely completion of the website is estimated by using the most likely amount method because the element of variable consideration has only 2 possible outcomes, that is 750,000 CU or 350,000 CU. Entity X should continue to use the selected method for each element consistently for the entire duration of the contract.
Okay, that is that. Now, what we are trying to achieve here is that there might be multiple elements that bring about variability in a single contract that has a variable consideration. Now, the standard permits us to use the 2 methods separately to address different variability in elements. Now, in that regard, it's possible for one element of variability to have a portfolio of data, which warrant us to use expected value method. The second variability in the element only warrant us to use most likely outcome or amount, which is because it does not have a portfolio of data. The spectrum is very low or close or bound, and in that case, most likely outcome will be a better choice of method. What the standard says is that we can use these 2 methodologies to address separate elements within a single contract based on their variability and available data, but switching those methods or using them interchangeably from period to period or instance to instance may not be allowed. Which then means that if you have chosen expected method as the most appropriate for a particular element, and you have chosen most likely outcome for the other, Such will be used consistently over the life of that contract. And that's what the standard is talking about. Now, let us come back to summarizing some of those other key things we have discussed so far on step 3. You will see that step 3 took us some stretch, and we'll go back to our presentation slide to wrap step 3 up. Now, as we have said earlier, step 3 allows us to also identify within the transaction price the financing component, which we have demonstrated our understanding of, where we have to account for financing component in line with IFRS 9. And that is that. But there are other key things I want you to know as follows. A significant financing component does not exist when the timing of the transfer of control of the goods or services is at the customer's discretion. Because that means customer might come to pay early. Therefore, you shouldn't anticipate such, which means at that discretion, it will be practically difficult and it will be more or less contingent upon customers' own timing, and which will make it much more a constraint for us to reliably measure it appropriately. In that case, we would not consider that there's a significant financing component. Secondly, where the consideration is variable with the amount or timing based on factors outside the whole control of the parties. Therefore, in such a situation, we will not necessarily consider it to have a significant financing component. Likewise, the difference between the consideration and cash selling price arises from other non-financing reasons, probably performance protection. In that situation, which means rather than treat the other components as a financing component, it will be more or less treated as performance component. And what does that speak to? It speaks to the fact similar to what we have done before, where you have a penalty for not delivering in 3 months. But in this case, it is not a penalty, but rather a form of incentive to ensure that you provide me a quality product that stands test of time, which means invariably, if you deliver the product, we agree 1 million, but in my own mind, or in our agreement, 800,000 deals with the product on its own. The performance of the product, as I use it over a period of time, will make me meet up with another 200,000 in full and final settlement of that amount, which then means that the 200,000 will not be seen as a financing component, even though it's payable far later, but rather it is in fulfillment of the performance of that asset or good over time as it is being put to use. Let us take note of that. Another one is that with discount rate to be used, the discount rate to use must always reflect the economic characteristics and the credit quality of the party that is more or less going to pay and the other party that will receive the money. These characteristics have to be taken into consideration, coupled with the fact that there might be any collateral that has been pledged. You know, when collateral is pledged, especially when it is sufficient, it reduces the interest rate. If it is partly not, is not sufficient, it will likely increase the interest rate. But if there's no collateral at all, there's much more risk inherent, which will demand for higher interest rates. But take note, the discount rate must reflect credit characteristics of the party receiving the financing and any collateral or security provided. Lastly, the issue of practical experience is key. Even where there's a significant financing component, if it is a component that shows that the interest is not for more than 12 months, it means the discount embedded in it is just for 12 months. And let us say, fortunately, the 12 month falls within an accounting year. It then means that instead of us doing this, I try to account for it appropriately on a month-to-month basis. It might not be necessary in material terms because everything still falls within that particular accounting period, which may not be necessary. And at that point in time, we might rely much more on practical expedience. Now, all what we have discussed in the bit of looking at our available consideration further, all of this has been discussed earlier. And I want Akifolarin to summarize it once again as we close out on step 3. We can't hear you.
Okay, sir. In summary of the step 3, determining the transaction price, accounting for variable consideration. Examples of variable considerations include discount, rebates, refund, credits, concessions, incentives, performance bonuses, penalties, and contingent payments. Variable consideration must be estimated using either expected value method, that is, based on probability weighted amounts within a range for large number of similar contracts, or either expected value method or single most likely amount, that is the amount within a range that is most likely to eventuate, that is where there are few amounts to consider. Constraining limiting the estimates of variable consideration. Variable consideration is only recognized if it is highly probable that a subsequent change in the estimated value would not result in a significant revenue reversal, that is, a significant reduction in cumulative revenue recognition. Accounting for consideration payable to the customer now. This includes cash paid or expected to be paid to the customer or the customer's customer, as well as credits or other items such as coupons and vouchers. Accounted for as a result reduction in the transaction price unless payment is in exchange of a goods or services received from the customer, in which case no adjustment is made. In which case no adjustment is made. Sorry, except where, okay, the consideration paid exceeds the fair value of the goods and services received. That is, the difference is set against the transaction price. The fair value of the goods and services cannot be reliably determined. Full amount taken against the transaction price. Okay, finally, accounting for non-cash considerations. This is accounted for at fair value. If not reliably determinable, it is measured indirectly by reference to stand-alone selling price of the goods or services.
Okay, thank you very much. Okay, thank you so much. Now we'll go back to where we started from. Okay, a 5-step model. To extensive point, we have dealt with step 1, step 2, and step 3. And in step 3, more or less delve into critical aspect of it. And we are still going to look at some other practical aspect of it as we move on after completing step 4 and step 5. Okay, so that we can look at practical situation or scenario that will move us from step 1 to 5 at a go. Okay, and today we'll be ending it up with where we stop now, which means we are stopping at step 3. And tomorrow we'll begin probably with step 4. How do we allocate this transaction price to various performance obligations? And thereafter, how do we recognize revenue when each performance obligation is being satisfied, whether it's at a point in time or over time? Any general question before we call it a day?
Yes, I have a question. Sir. I've been looking at this idea of time value of money, and we are taught in finance class that any financing arrangement that is within a year, time value of money will not apply. It applies only to an arrangement that extends beyond a year. So I want to know your opinion.
Not beyond, a year and above. A year and above.
Okay, a year and above. So I want to believe that this is based on the situation in Europe and America, where market and financial data are stable. But when we come to Africa, that are generally very, very volatile, different countries in Africa are very volatile.
Inflation rate is high, interest rate is volatile.
Look at where we started from this year in terms of the value of Naira, the interest rate, and several other parameters, and where we are just 6 months into the year. Can we still reasonably say that any financing arrangement that is within a year should not, time value of money should not be reflected? So I want to know your opinion, sir.
Okay.
Hello, sir.
Yes. Okay, I'm coming to that. I'm coming to Yaki Falain.
Oh, no. I just want to mention something to buttress what you said. Because, for example, in this year, there's this exchange rate difference that I've done this year. And while I checked it earlier this June, I realized that so that the organization will not be in a loss position in terms of exchange losses, it is very important for one to reevaluate such the exchange rate for this year. That is why I'm asking, in addition to Shegun's questions, that should such a thing not be considered within a year?
Okay, now there are two separate questions. Let's put exchange volatility, FX volatility on one side. Okay, FX volatility does not speak to time value of money. It's a separate effect. But let's look at time value of money now. The word time value of money starts from a year. Okay, the reason being that the effect of the discounting will have been recognized with or without time value of money recognition if everything falls within the same accounting year. That's just the basic principle of it. If, for example, I separate a financing component, okay, whether I do it or not, everything still affects profitability in that year. Does that make sense, sir? Unlike if it's for 2-3 years, it means instead of me affecting everything in 1 year, there's a component part I will spread over 2-3 years. Are you getting it now? And that's why in accounting arena, once the effect of that time value of money does not span more than an accounting period, or more than a year, which will be rolling effect based on the fact that such transactions are routine transactions that occur over time. You find out that the whole of that effect will not span more than 1 year, and in that manner, it will not be necessary to accord it that strict issue of time value of money, because everything will still be captured in a single year, which does not necessarily impact your profitability, nor affect your financial position. Because if I do all the unwinding, I still unwind it into the same year. Do you understand? The only difference will be slightly the amount of revenue and other income, or the amount of cost of sales and finance cost, but it's still similar component that affects profitability that year. And there's a general consensus that says that effect of time value of money may not be necessary for a period below 1 year. And that has been the general consensus in the finance world. Does that make sense? Now, the issue of FX is secondary. Treatment of impact of FX volatilities may give rise to translation exposure, okay, which is what we are talking about. And that is what is contained in the requirement of IAS 21, the effect of changes in exchange rates. And the treatment is such that at every reporting date, you will measure by way of translation of your monetary asset and liabilities at the rate ruling as at that date, of which, whether realized or not realized, the exchange difference attributable to monetary asset and liabilities are immediately recognized in profit or loss. And that speaks to that. Again, you can go on the YouTube again and watch my video that speaks on salient issues regarding the impact of changes in foreign exchange rates on companies' performance, financial position, and of its cash flows. Okay, in the absence of anything to the contrary, thank you very much for part 1 of this discussion. Tomorrow, we'll continue on part 2 of the discussion. Goodbye.